Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings. Today, we're diving into Celanese's annual report, and let me tell you, there are some interesting plot twists. Think of it as a chemical reaction, where not all the ingredients mixed quite as expected. First things first, like any good corporate document, there's a heads up about forward-looking statements. Basically, Celanese is saying, we're making predictions about the future, but a lot can change. They use words like believe, expect, and anticipate, but warn not to take these as guarantees. It's the company protecting itself from future financial missteps. So what does Celanese actually do? They're a global chemical and specialty materials company. They make high-performance plastics and acetyl products, which are used in almost every major industry. Think car parts, medical devices, and even the stuff that goes into paints and coatings. They have a large global footprint with 56 production facilities, mainly in North America, Europe, and Asia, and employ over 12,000 people. Celanese breaks down its business into two main segments: engineered materials and the acetyl chain. The engineered materials segment is all about those high-performance plastics. They're used in things like cars, medical equipment, and electronics. A big part of their strategy is this project pipeline approach where they work closely with customers to develop new products. They also have 17 strategic affiliates or partners around the world. The acetyl chain focuses on acetyl products, which are chemicals used to make paints, adhesives, and textiles. They also make things like acetate tow used in cigarette filters. They run an integrated business with the ability to supply solutions across global geographies utilizing various feedstocks. What about the odds and ends? Other activities is where Celanese lumps all corporate overhead expenses, interest costs, and captive insurance results. It is not part of either segment's core activities, but is a necessary part of the business. Strategic affiliates are an important component of Celanese's global strategy. They are a portfolio of holdings that provide geographic reach and access to new products. These partners are mostly located in Asia, and the company owns a stake in them ranging from 25% to 70%. Sustainability is also on their radar. They're working on reducing their greenhouse gas emissions and developing more sustainable products to help their customers meet their own environmental goals. Now let's get to the risks. Celanese isn't shy about listing what could go wrong. A big one is the global economy, since their business is tied to overall economic conditions. They also worry about the price and availability of raw materials like ethylene and methanol. If those get too expensive or hard to find, it could hurt their profits. Production disruptions are a major concern. Things like fires, natural disasters, or even just plain old manufacturing problems could shut down their plants and mess up their ability to deliver products. The company acquired the mobility and materials business from DuPont a couple of years ago. Integrating that acquisition is a big undertaking, and there's always a risk that they won't be able to achieve the expected benefits and savings. They also talk about credit risk, meaning they're worried about customers or suppliers going bankrupt and not being able to pay their bills. We're reminded that the company has had significant events occur in the last few years that have negatively affected operating results. On the financial side, they highlight goodwill. Goodwill and indefinite-lived assets are reassessed each year, and if the value goes down, it will have a material negative effect. That actually happened this year, more on it to come. The company's insurance coverage may not cover all operational risks, which could lead to uncovered losses of all sorts. Cybersecurity is also a big one. They face constant threats to their computer systems, which could disrupt their operations or lead to data breaches. Finally, a word on dividends. Celanese is clear that they can't guarantee future dividends or share repurchases. These depend on how well the company is doing and other factors. They even announced a plan to reduce their dividend in early 2025. The company has developed sustainability goals and that, if failed to be met, there can be negative impacts to the business. There is also the complex nature of operating across international borders and maintaining tax compliance everywhere. Now for the numbers, let's look at how Celanese performed last year. Net sales were down 6% compared to last year to $10.3 billion. The decline was attributed to both lower prices and reduced volume. The biggest hit was seen in profits, with an operating loss of nearly $700 million compared to a profit of over $1.6 billion the previous year. A key factor in the profit decline was an impairment loss of $1.7 billion due to writing off goodwill. This goodwill issue alone significantly impacted results. Their effective tax rate saw a large swing due to one-off items relating to tax benefits. Breaking it down by segment, engineered materials saw a sales decrease due to lower volume and pricing. Their operating profit also took a dive, mainly due to that large impairment charge and the previous year's gain from forming the Nutrinova joint venture. The acetyl chain segment also experienced lower sales, driven by a less than ideal supply versus demand situation. Their operating profit was down as well, but they were able to partially offset this with lower raw material costs. Digging into operating expenses of other activities, the operating loss went down in part to lower compensation cost. A large chunk of other activities are allocations for corporate admin costs. Acetyl chain also has large strategic ventures, and in some cases, they do not share full financial information with the company, reducing visibility of performance. Celanese ended the year with $12.6 billion in debt, and they are trying to reduce this, partly by decreasing how much they pay out in dividends. Interest is now around $680 million. The size of the debt is significant in the event of economic stress. Cybersecurity is clearly taken seriously with comprehensive risk management programs. At the board level, management updates our stewardship committee and full board on cybersecurity matters quarterly. The compensation-related details and board info is skipped in this filing to instead be disclosed in a latter proxy statement. Alright, we made it through that complex filing. Now let's zoom out and consider our takeaways. On the positive side, Celanese is taking sustainability seriously. The company's pause of share repurchasing might spook shareholders in the short term, but in the long term could be the right choice by focusing on debt reduction. It's hard to look past that massive goodwill impairment charge. That's a clear sign that they overpaid for an asset, and a lot of their efforts are now focused on paying it off. This indicates overconfidence or exuberance in prior management. The drop in stock price also prompted a credit ratings downgrade by Moody's, which doesn't inspire a lot of confidence. In conclusion, Celanese is facing some serious headwinds. It will be important to see how they manage their debt and continue to generate cash while working towards its sustainability goals. Thanks for watching. If you found this breakdown helpful, please like, subscribe, and let me know what company you'd like me to decode next.